Hi, good morning. Sorry, I lost my voice. My name is Lily Tong. I'm from Chase Bank, and this is 7 years in the business. Thank you, and have a nice day.
Hi, good morning, everybody. My name is Peter Cheng from Union Bank. I've been in the industry for about 16 years now. Started when I was 10. Nice to be up here.
Good morning, everyone. My name is Vic. I'm with Wells Fargo. I've been with the banking industry for over 5 years now.
Perfect. Okay, well, we're going to start in a sort of a alphabetical order. As you know, what we do is we collected some questions that are usually asked to the people of the industry. We have the lender industry, and we're going to start with Vic. We had also Chris Hahn from Gem Mortgage, who took Yale today and will not be with us. So we're going to kind of like spread some questions around, and we're just going to hope to keep you well informed on what's going on in the lending industry. We're going to start with Vic, in alphabetical order. Vic, can you tell us about the directions of interest rates, how they're going this year, and what we can expect, where we can expect them to go? How are they today?
Great question. The interest rate market is most likely, it's already been going up. And there's a lot of factors. I mean, we're just going really short. It's, bonds, market, employment, unemployment rates. They're all affects the interest rate. And you're going to be expecting it to increase, steadily increasing in the next year or so. And that's what you should be expecting.
Perfect, perfect. Let me switch over to Bob. And we have a $5 member today. I'm going to switch over to Bob. Bob, could you tell us what exactly a reverse mortgage does and how are they functioning nowadays?
Well, busier than ever, by the way. It's a great time for our business. A lot of transition going on. The way it works is like a negative arm. You start with either zero or the amount that you're borrowing on your equity, and it's interest that's compounded monthly. So eventually, at a certain period of time, you're going to run out of equity. It doesn't bother the senior as far as he's living or she's living or they're both living in a home. They can stay in there forever, even if it goes upside down.
Okay. We're going to go over to Lily. Lily, how is the refi market now? And what kind of refi? We've been hearing a lot about cash out refis, particularly when there is a home that was bought cash.
First of all, sorry. We have a lot of refi cash out right now, especially when the purchase were all cash purchase. But basically, some people, they have the misunderstanding is they thought they can refi immediately. For some reason, there is a seasoning of 6 months. But for Chase, we have the refinance cash out program. You don't need to have to wait. But of course, it's also full doc transaction. As long as the purchase were all cash and unsecured, that you can immediately apply for the cash out up to the LTV, the purchase. You need to follow the program policy, and there is no seasoning limit. So that is one of the way right now we are doing a lot of transaction. As long as the buyer, the purchase, originally for some reason they purchased the property because of the property itself need to be repaired and may not pass the guideline of the appraisal. That's why they were using all cash purchase. And when they fix the property, they can immediately go to the refi cash out. They don't have to wait for 6 months.
Okay, perfect. That's giving us a little indication of what's going on in the refi market. Now over to Peter. Peter, what programs other than FHA are available for buyers with less than 5% down and with, I guess, without MI?
I know that there's certain programs out there such as HomePath. I know that some of the lenders here, Wells Fargo, some of the brokers can also carry HomePath as well. So that's a great program, but then there is a requirement on HomePath that you will have to purchase the property through the Fannie Mae homepath.com. There's another program that Union Bank can offer, which is what's called the Economic Opportunity Program on mortgage. It's known as EOM, which requires 5% down with no PMI. It's very competitive when it comes to rates wise, 30-year fixed. The only requirement is that it does needs to be in a census tract or income requirement, which with the income is at 74,000. So there are certain programs out there that's very comparable to FHA if some of your customers cannot pass the condo certs. Because I know with HomePass it does not require an additional appraisal or condo certs because it's all Fannie Mae approved. So these are the two current programs that's currently out there.
Perfect. Now over to Sophia. There have been a lot of changes. There are been a lot of changes in lending, and most recently with the coming new year. And there's this thing called QM. What exactly is QM?
Well, I'm sure as a real estate agent, you guys receive a lot of emails and flyers and whatnot talking about QM. It started in the beginning of this year. QM stands for Qualified Mortgage. Now, the government cracking down on lenders who are putting more responsibility on us to really make sure that we are making qualified mortgages. In other words, we have to make sure the borrower qualified. Ability to repay is so important. Now, we're talking about ratio at 43%. You might say, well, the 43% is really getting tight. You can hardly qualify anybody, but when you look at numbers, I want to give you an example. 43 is really not too bad. I started business back in the 80s. We are talking about 28 and 36. So 43 for a while, we're doing 45 and 50. To me, personally, it's a little bit too high. If you look at somebody makes $5,000, they pay 30% tax, and that's $1,500. So you only have $3,500 left. And your 43%, that's principal, interest, taxes, insurance, and plus other debts. Let's say you have a car payment, your student loan, everything total to about $2,100. That's 43%. So leaving you with $1,400. Now, $1,400, don't forget, you have all the other stuff. You have a lifestyle, you have utility bills, you have car insurance, medical insurance. So really, 43 is not too bad, okay?
Perfect, thank you. Vic, back to you. How do bonds affect mortgage interest rates? Yeah, how do bonds affect mortgage interest rates?
That's a technical question.
Is it a question? Or how are they affecting, I guess?
No, it is a question, but really bonds is really just a large organization when come together to form bonds basically. But essentially, we look at treasury notes. So for example, if you were to go on any websites like Yahoo Market and look at treasury bonds note, mortgage rates usually is a little higher. So that's how you can, I guess you could say, gauge if it's going to increase or decrease in interest rate. However, since bonds are competing with interest investors, when bonds increases, usually the rates increases. So that's how you really gauge on the interest rate.
And are we seeing any of that going on right now? How are the bonds affecting the current market?
It is the only reason it is affecting as in the sense where there's a lot of other options for investors to purchase bonds or stocks, and that's basically buying power. So when bonds decreases, interest rates tends to decrease, and when bonds increases,
Perfect, perfect. Lily, what is the best pre-approval option for folks?
Right now, because Chase, we already forecast purchase is the dominant market right now. So our manager, the senior management, they decided to have a pre-approval program, what we call HBA program, is helping all the realtors, especially and the buyers. We preliminarily let the borrower to do a pre-approval, and the major part, the benefit part, is underwriter approve the loan. So basically, when the realtor, they send the customer to us, for example, my related realtor, they send the ball to me, Lily, help me to pre-qualify this customer. I say, no, I'm going to pre-approve the customer and let the underwriter approve the loan. So that means the borrower, when they have the letter with pre-approval, is already 75% done, the loan. So the only responsibility for the realtor is help the buyers to find the house. And once the house is accepted, have the contract, and the remaining is we just finish the appraisal. So we can close the loan even faster than what you are thinking. So right now, based on my all the pre-approval that I have done, and the buyer luckily they find the house, we are pushing the seller to move out. The loan is already done. So I think that is a very good program, and I hope that we can build a relationship with all the realtors, especially, it doesn't matter as listing agent or sales agent, as long as you have some customer you thought about, they qualify or not, just send it to me, and then I can do the pre-approval for you guys and have the loan done and just waiting to find the house.
Perfect. Speaking of approvals, Bob, this is going to be a question for you, and also if you could give us, it's going to be a combination of two questions. What FICO score do you need to qualify for a reverse mortgage, and where have you seen like the best case scenario for a reverse mortgage? That's over to Bob, please.
Okay, FICO score, you're not required, or you don't have to have a FICO score. Anybody in this room that's 62 years of age or older, and you're qualified. You're pre-approved. All you have to do is have equity and the value of the home. That's it. Basically, that's about it as far as FICO scores are concerned. We, under the, just to expound a little bit, the direction the reverse mortgage is going to be doing the QM, but ours is not going to be as drastic because they don't have to have an income to make payments because there's no payments required. But the ability to pay would be possibly the protection for the senior, where they have enough funds to pay taxes and insurance to avoid defaults. That's one of the requirements for reverse mortgage, is that you pay taxes, property taxes, and homeowners insurance. As long as you have that going, then no one's ever going to knock on your door. You're never going to get any letters from anyone else.
Perfect. Perfect. Thank you. Peter, for loan amounts over $625,000, what special discounts are available for purchases, and up to what amount?
Jumbo.
In terms of the jumbo, exactly.
So I know there's certain jumbo lenders that's well known, such as Citi, Wells Fargo. I know Chase is being really aggressive. So is Union Bank. Just let you know that with Union Bank, we do broker our loans out as well. So for some of those that have brokers that carries our product, you guys know some of our programs. With the jumbo products, there's currently right now, there's a 30-year fix. You can get up to 0.5% discount. So you're getting in the low fours on $625,000 and above on 30-year fix. So that's one of the programs that's currently out there with our portfolio product. So that is a portfolio. It's not going through Fannie, Freddie, or other government agency products. Because Union Bank have a lot of these portfolio products that can help jumbo lenders, such as the ARMs. We also have 1-1 ARMs, 3-1 ARMs. So these are some of the additional programs that can help with jumbo lenders.
Perfect. And over to Sophia before we wrap it up. Sophia, what are the effects of the loan amount changes?
Well, going back to my first question, I want to add something. I think most people understand what debt to income ratio 43%, right? That's your total debt plus payment divided to your income. Now, I'm not saying that if your loan is over 43%, it's not approvable. As long as all lenders are pretty much using computer underwriting called DU, desktop underwriting. So if the DU is able to approve you over 43, you're fine, or a lot of lenders are choosing to use manual underwriting, but your file has to be really clean, cream of the crop, that type of thing. So it's still possible. As far as the loan amount, it doesn't really affect our area too much. It's mostly on the FHA. You know, you're talking about San Bernardino, Riverside. They have lowered the loan amount, which is going to affect some areas like Corona, you know, and the Rancho Cucamonga. There's some houses close to $1 million, so you're going to have a little problem. Otherwise, in our area, I think we are okay with that. And as long as the conventional staying at 417, we'll be in pretty good shape this year at least.
Perfect, thank you. Now we're going to open up the floor for questions. We're going to allow for maybe like 5 questions. So in the interest of time. Carl, if you can project to the whole room.
Robert Tapia. Can you hear me, guys?
Yes.
No? Okay. On the reverse mortgage, give me an example of somebody that has had a senior that's had real success. In other words, it's done a good thing for them, and maybe in some situations they made a mistake, they got a reverse mortgage, and it was a disaster.
I think, let me get the disaster first, because I think everybody listens to a negative climate in a scenario. Okay? People were using reverse mortgage for the wrong reasons. It was designed to keep people in their homes, seniors in their homes, and survive their retirement ages and have income supplement to what the retirement accounts were. What happened is, during the excitement period in the 2008s and 9s, or prior to that, where house values were way high, they pulled all cash out. Some seniors had $200,000, $300,000, in some cases $400,000 in their pocketbooks. A long story short, I have a senior that wanted to refi her reverse mortgage, gone bad. I went to her house, she needs more money. In her driveway, she had 3 brand new cars. She spent at least $25,000 each. One was for her son-in-law who lost his job and he needed a car to go looking for one. The other one was for her granddaughter, the husband, that was her husband. She had a baby, she needed a car to take the baby to the hospital or doctors. The other car was in the driveway, never driven. The lady has a broken hip and a broken leg. The car was delivered to her driveway. It had never moved from the time it was delivered. She spent $75,000 of her equity with no means of supplemental income to write out the retirement age.
Not a success.
I told her to go sell them all and take the bus.
The successful.
Okay, the successful ones, if you take a line of credit rather than all cash out, you have the ability to double your retirement income in a period of 10 years. So at age 80, I think that's the time that people start really, really thinking, what do I do? How do I live? How do I continue to live my lifestyle? If you leave your line of credit, which grows at 4% monthly or annually, and by the way, our line of credit is never taken back by the bank. Doesn't matter if your loan is going upside down, the line of credit continues to grow. You might have $200,000 to $300,000 at age 80 or 82 that you could pull out in a matter of 5 days. At age 80, without working and living in your home, and be able to pull out $300,000, I think that should be sufficient funds to write out the rest of your life.
The problem is that when you have cash, like the lady with the $75,000, cash is dangerous. It makes bad mistakes.
We found that out in a lot of cases. So actually the new changes, like everyone else is going to do changes, October, that change came about. You can no longer pull all cash out. They actually hold it in reserve, and in a lot of cases, it's the best thing for them. Fixed rates are fine. Adjustable rates have a line of credit growth. Where fixed rates out, you pull your money out, you have to wait an extra year to pull the additional money that's left behind. You have to refi that loan to get cash out, and hopefully the value has gone up in that meantime, about a year, and possibly to pull more cash out. I don't recommend that. I recommend lines of credit with either supplemental income monthly or take what you need as you need it and let it ride. Let it sit there for the future.
Any other questions? Oh, we have a question. Thank you. Thank you for coming to the microphone. Oh,
Actually, I have 2 questions. Is that
Excuse me,
okay?
can I iterate? You can also buy a house with a reverse mortgage.
Okay, my first question is, do you refinance a manufactured home on a permanent foundation?
does anyone here on the panel refinance a manufactured home on a permanent foundation?
With the manufactured home, there's actually certain tighter criteria, but yes, Union Bank can. There's certain age of the home's requirement and along with certain foundations. Also, there's a lot of different guidelines, but yes, we can take a look at it for you, if you do have a customer or if it's for yourself, and see if you can qualify for it.
Would that be something where there's individual underwriter guidelines?
Yes, there is.
Okay.
There's individual underwriting guidance, so if you're interested, we definitely can provide more of the underwriting guidelines.
My
If I could
second
interject.
question,
Okay, I can also do mobile homes for manufactured homes from 1979 and up. It requires an APN number. You have to own your own property. You cannot be in a park.
Got it. So if it's a manufactured home and it is on a permanent foundation, it would have to have its own APN. The land is going to be theirs, yeah.
My second question is, I recently, through the telephone, I never met this young loan officer in Orange County. He told me that he is being able to giving a purchase loan and without checking the income. However, you do have to do a financial statement. You do have to have 720 FICO score. All you need is 30% down, and you can do stated income loan.
Stated income loan.
Is that workable? Is any of you can do the same, or is young man just talking?
Is this young man just talking? So are there any stated income loans, I guess, throughout the panel?
You know what? Very few out there. Most of them are local community banks. They might still be able to do it because on a state loan, you know how risky it is. And especially, when you look at the government, go, well, if you can qualify, how come you're not reporting the income? So basically, stated income is a thing of the past, especially for Fannie Mae, Freddie Mac, these agency loans. So I've heard some local banks, they were doing it, but starting this year, they're getting out of it.
So on that line.
And then on top of it, this lady was talking about this loan officer. Basically, you really have to make sure you're doing business with someone that's really experienced. I have this customer came to me, it's 3 weeks in escrow, and it's a big bank. For some reason, there's a little something that's they knew in the beginning, but after 3 weeks, they come back to them and said, no, we can't do the loan. And then they came to me in 3 days, I had them approved. So you really have to talk to someone that's knowledgeable, someone that you have worked with, and it's a good team of yours,
On those lines, that's to say that the QM that you spoke about earlier is going to apply to all loans, including the loans that this person proposes to.
Well, yes, of course, yeah, it's going to be agency loan.
Agency
Yeah.
loan.
Yeah, if I could interject, I don't do forward loans, but I do read up on things. If it's a portfolio loan and the bank's going to carry the paper, they can still do a non-QM loan to a certain point.
Especially with the Dodd-Frank Act that passed last year, most of the lenders are they're required, most of the large lenders are required to withdraw from having these type of stated income programs. Some of these larger banks, what Teresa was saying that with smaller banks, yes, community banks, they might still be offering it, or private investors that have certain programs. But typically the rates are a little bit higher, just because of the demand currently right now. But yet they cannot charge over a certain amount of interest as well.
So that gentleman could have tried get your business gimmick, is what that sounds like. We have another question over there, someone who's lined up.
Hi, Bob. Scarlett Johansson, representing 20 West Coast Broker. My question to you on the reverse mortgage, does
Okay, yeah, hold on. Could you get closer to the mic?
well, it is too high.
Oh, okay.
I'm thinking it might
It's
But
a-
anyway, does the living trust, if a property is in a living trust, how does that affect the reverse mortgage? Is there any?
You have to think about it.
Basically, I recommend.
The question was, if the property is in a living trust, how does that affect, or does it have an effect with reverse mortgages?
Yeah.
Only if it's a irrevocable living trust, then they have we can't do that, it's a little bit more difficult, but I recommend most seniors to do things, prepare themselves and get a trust in place, just in case one of them can't continue, that there's no problem with succession. Also, if there's they have to move out of the house, their children or the authority person, which is power of attorney, they have the ability to negotiate out of a reverse mortgage. I've seen some situations where it goes to probate only because they didn't do the right thing, they didn't entitle the property correctly, and it gets into a really juggernaut. And in fact, I'm dealing with one right now. But it looks like we're going to navigate out of that one. But yeah, I would recommend a living trust, whether it's done in advance or during the process or afterwards. A person should have it.
Well, and let me just ask a question to further clarify that one. Do any of you loan to a trust? In certain instances, correct? In certain instances, you do loan to a trust, but mostly, like in the question that she was saying, the people would qualify for the reverse mortgage, and then they would put their home into a trust. Is that pretty much the...
They could have a trust already. I have some that are that way. It's just the way it's recorded on a reverse mortgage.
Thank you.
Any other questions for the good of the... Oh, yes.
The QM. Is the QM designed so that we don't have that terrible disaster financing? There's guidelines that keep the Wall Street from going crazy?
Can I answer that?
Sure.
Because I try to read up on that. The QM, the ability to play, it puts pressure on the loan based on the qualification, so that if there is a downturn in the economy, that person's able to survive. Before, they was just stated, it was a no looking, no seeing, and they couldn't survive because they never knew if they could survive. So I think that's the pressure of the QM, is to make sure that even in a downturn market, that person with that loan is not going to have a problem with ability to pay.
Sophia, do you have any more insight on that you could offer us?
Well, that's pretty much it. That was very good. On top of it, it's just overall, not only talking about your overall abilities, the program is kind of program, the DU that I was talking about, underwriting, especially I'm talking about agencies, okay? Reverse is a totally different story. But in general, I think most of the realtors we are talking about, the customers, you want to go through agencies, which is Fannie Mae, Freddie Mac, and the FHA. And they're programmed as such that they look at overall picture. You know, they tighten on all areas, not only just the ratios, credit, how long you've been on a job, what are your reserves, and overall pictures. Okay.
Well, yes, Carl. Yes, Carl, I'm just wondering.
The entire group here are really, the banks are agents for Fannie Mae, Freddie Mac, and so, the government is the people, us, and we're really the ones that are making the loans or guaranteeing the loans, and these guys are working on behalf of us.
They are working on our behalf, and we encourage you at that note to continue to support your affiliates. We have some of the best affiliates here in the lending, as well as in all the other industries
Marcus,
related.
can I say one more
Yes,
thing?
please.
I think we all should be responsible for it. You know, I mean, I know when you're talking about real estate sales and you just want to borrow to get the loan, but overall, you know, don't get involved with the loan process. There's very intricate. Let the loan officers do the work, and we all have to be responsible. Not only say, okay, all I want to do is close this transaction. That's not it. It's down the line. What happens if they're not making the payment? If they go to default, you have to feel somewhat responsible. How was the loan approved? Did you make something to make it happen? Or are you contribute to this? So overall, we should all be part of it and feel responsible and be a professional.
And the reason we asked this panel was because they're some of the hardest working lenders that I know. So thank you very much for your participation. Thank you for your questions.